Ladies and gentlemen, welcome to FinFluential Media. We have another episode, a jam-packed day for a jam-packed week ahead. And we're going to discuss everything about the markets. We're going to look at the recent Wall Street revisions. People are changing tune. And what is my target for the rest of the year? Have I changed it from my 6,600 level? We're going to talk about the Mag 7, Donald Trump, and then we're going to get into stocks that I bought today and for this week. But guys, if you are new here, put on your sunnies. Okay, Buffett's got his sunnies. I got my sunnies. Put on your glasses. Go ahead, hit that subscribe button as well. It means a lot for small channels like this. We only have 300 subscribers, so go ahead, hit that subscribe button, guys, hit the like button, leave a comment, okay, and let's dive in. Now, the S&P 500 today, up 0.64%. Normally, Mondays have been pretty red, but things were looking pretty good. It was a bit dicey here to start the day off, but as the day progressed, we found our footing and pretty much made it to intraday highs. Came off here at the end of the day, a little bit red in the extended hours, but we're all good. Now, we saw the mega caps underperform. Nvidia and most of the mega caps were down today, actually mostly just the Magnificent 7, but we saw all other sectors gain. Look at healthcare, Novo Nordisk, that's a European stock as well, up 3%. Robinhood up 7%, high beta rally today. Financials, JP Morgan up 0.74%. Even staples catching a little bit of a bid. Coca-Cola up in excess of 1%. Every single sector was green today here on St. Patrick's Day, with the best performing sector being stuff like energy as well as real estate, up nearly 2%, both of those. But it was a pretty solid day across the board. The worst performing sector was the cyclical space, consumer discretionary. Now, guys, I really thought today, Monday, was going to be a red day because we had Scott Bessent come out over the weekend and he said there are no guarantees there will not be a US recession. Now, I think we have to cut Bessent some slack. It's his first time in the political limelight. He's just coming into this position here with Donald Trump. And look, he's trying to navigate the media because with the Trump presidency comes a whole bunch of media obligations and they really do attack you. So, he's trying to navigate this. He did walk this back, and that's part of the reason why we're green today. But, Bessent saying, hey, troubling times ahead. And that is why we've actually seen a lot of the big names who were very, very bullish on the street roll their S&P 500 targets back. Now, my S&P 500 target to finish the year is 6669. Okay, sort of right here in line with Bank of America. That is my end of year price target. It's unchanged. I'm not going to change it. I think I'm going to leave it as it is. From where we are right now, 5,500, that would represent close to 16% upside from where we are right now. Yadeni Research decreased their price target to 6,400 from the 7,000 level. Lori Calvasina from RBC Capital Markets decreased hers from 6,700 to 6,200, and Goldman Sachs did the same, except their initial target was 6,500. So we have seen quite a number of price target revisions for the S&P 500. And I think, the people are looking at the economy saying, hey, things are definitely slowing. And we've also seen the Magnificent 7 names pull back. That all of these names are pretty much in a bear market being a pullback of 20% or more. A correction is 10%. So you go from a correction into a bear market, and we're all in a bear market here. Tesla in a deep bear market, having lost half its value from its 52-week highs. Pretty much all of these companies made their 52-week highs in early January, very, very late December. And when you have the Magnificent 7 all pull back like 20%, 21%, 23%, the market is going to feel some pain because 30% of the S&P 500 is just 7 stocks, the Magnificent 7 names, whereas 69.2% is the other 493 stocks. So guys, you're gonna definitely feel pain when you see something like this. Before we get into stocks that I bought today, we're gonna talk about Donald Trump and market volatility. Okay, so ever since becoming president, this is when he became president right here, guys. He's had a number of things to say about the market, so we're gonna look at all of them. Okay, so November 5th, Donald Trump is elected president and he promises America's future will be bigger, better, bolder, richer, safer, and stronger. He loves that type of vocabulary, spectacular, interesting. He loves that. Stronger, richer, better than ever before. And so that's what he promises, and the markets rallied on the back of that. And then we kind of traded sideways here in 2022. He said they're calling it the Trump effect because even before taking office, we're already bringing in the jobs and the opportunity and safety and common sense back to the USA. In his inaugural address, Trump promises we will be a rich nation again. I'm not sure if Donald Trump knows this, but America is the richest nation in the world right now by a long shot. Now, in February 4th, when the market continued to trade sideways, he was asked, how is the market doing? And he said, I don't really think about it. And this is when the market got a hint that he's not really looking at the market as much as the S&P 500 as much or the Dow Jones, but more the 10-year yield. And that has to do with Besant. Now, on Feb 19th, that turned out to be the market peak. We actually hit all-time highs. He said, we're on the verge of soaring markets and a quantum leap in the quality of life. On March 7th, after we were about halfway through this correction we're in right now, look, what I have to do is build a strong country. We can't really watch the stock market, alluding to the fact that he's looking at the 10-year yield. Besant is in his ear. On March 11th, he said some people are going to make great deals by buying stocks and bonds and all the things they are buying. Very, very true. And this is where we are today, or I would say in the last week. I think a lot of the stock market going down was because of the really bad 4 years that we had under Joe Biden. True. Look, Donald Trump is trying to right the ship, at least what he thinks is right, and that is going to come with a little bit of short-term pain. But here we are. We haven't got anything new regarding the stock market from him just yet, but we'll keep track of Donald Trump as we always do on this channel and my main channel. Now, guys, I'm going to talk about two stocks that I believe are incredible value right now that I actually bought today. One of them is EVVTY Evolution AB. Now Evolution Gaming. Now, you need to buy this stock and you do not stop buying this stock. I have about 900 shares here. Now, here on the 17th of March, guys, I bought 100 shares of Evolution AB. I have 900 shares right now. It's still a very small part of my portfolio, about 7 or 8%, somewhere along those lines. I'm only up about 3% on the position. My average cost basis is very close to there, $76.56. I absolutely love this company. Now, the financials for Evolution are just fantastic, just absolutely fantastic, okay? Now, Morningstar rate the stock with a 3-star rating, meaning it's slightly below fair value with a narrow economic moat. They have a strong financial health and a high uncertainty rating. Now, going over some of the financials in the last year, the stock hasn't done so well. It's down about 40%. But if we actually look at it year to date, we're up about 3%. So outperforming the S&P 500 by quite a wide margin, really just trending sideways. And we're sort of hitting a peak here at this $80 range. You can see that we're sort of finding quite a lot of resistance right here at $80 around that area here, multiple times yet. But once we break above it, onward and upward. Now, the stock is actually pretty reasonably valued. It trades at a PE of 12, a forward PE of about 11. Okay, they are growing earnings. They pay a 3% dividend. It's actually very closer to 3.5% because they pay in euros. But this is USD converted. And the financials of this company are just great, okay? They do $2 billion in revenue. They have exceptional margins, 100% gross margin, 64% operating margin, 56% net margins, and then a 55% free cash flow margin. Just insane when you think about it, right? Now, the balance sheet of this company is incredibly sound. They have $800 million in cash and cash equivalents. If we go down all the way to total debt, 93 million, that is it. So a very, very sound balance sheet. Their capital ratios are extremely healthy. 31% return on equity, 21.7% return on invested capital. Currently a free cash flow yield of 7.87%, 8% earnings yield, pays a 3% dividend yield, and the total shareholder return every single year is 6%. Now, this is what I believe for the next 5 years. So you have the revenue figure right here again. This is in US dollars, not euros, and we grow that by about 11%, 10 to 11% over the next 5 years, decelerating ever so slightly. Margins are expected to contract. Do take into consideration this is sort of like a bear case scenario. The best case would be, we sort of trade at 11% revenue growth and margins stay at around 60%. But I am factoring in some margin contraction using a 13 times EV to free cash flow ratio. So you take the free cash flow here at the end of 2029, guys, multiplied by 13, you get the enterprise value. Then you subtract the cash, add the debt, which is the net debt, subtract the net debt of 772, okay, and then you get the equity value, and then divide it by shares outstanding. I'm actually seeing shares fall by about 2% every single year. They are buying back quite a bit of shares, and that puts the 2029 stock price at $133. Current share price is $79. You add the dividend yield of 3.9%, that is the actual yield in US dollars, and you get a 5-year projected return on extremely conservative estimates of 14%. This is extremely conservative, and I think you can actually see revenue go up, guys. Here, when we decelerate to 10 and 9%, I think you could actually see revenue growth very close to 11% all the way through 2029. In fact, because of the unit economics, in fact, as the revenue grows, margins shouldn't decelerate like this. And there could be a situation where we see 58 or 57% net margins, 11% revenue growth, and then the projected 5-year return, again, still using a 13 times free cash flow margin, would be very close to 17%. And at that point, if margins continue to stay robust, 11% revenue growth, you should see further multiple expansion, and that could extend the overall projected return. So this is what I love to see, where the risk to reward is extremely skewed to the upside with minimal downside, and that is why I like Evolution. That is why I bought more. Another stock I bought more of today is PayPal. Okay, now this stock has had quite a wild ride in the last 12 to 18 months, and over the last 5 years has been absolutely insane. But I bought 253 shares of PayPal today. I own about 1,000 shares. My average cost basis is about $62. I did average up quite a bit. I made my very first purchase at about $52 here in PayPal. Now, I absolutely love PayPal because Morningstar see them as a 4-star rated stock. They have their fair value pegged at $104 with a narrow moat and a very high uncertainty. And I think the value for PayPal here at $68 per share is just crazy. Now, in the last year, PayPal is up only 10%, but at one point it was up 50% at $91. So it had a great year. I did actually unload a little bit of shares here at the top, but I continue to hold and believe in the long-term prospects of the company. Now, the company trades at a 13 times forward PE, and the company is just generally undervalued. If we just go to the financials, right, we go to the ratios, scroll all the way down. If you look at the return on equity, 20%, right, and return on capital employed, nearly 17%, the 6% earnings yield, and a 9.8% free cash flow yield. Just insane. So immensely free cash flow generative, and they're buying back a ton of shares. 6% buyback dilution yield. So they bought back 6% of their shares in the trailing 12 months. The company's balance sheet is very sound. They have very close to $10 billion in cash just sitting there. And if we scroll all the way down to total debt, $11.8 billion. That's an incredibly sound balance sheet. And if you go to the income statement, they did $31.8 billion in revenue. If you scroll all the way here, you look at the free cash flow margins, right? 21.8%. But if you actually just go to the quarterly figures of the free cash flow margins, you can see that the margins have been expanding ever since Alex Chris took over the company. We went from 17 to 18, 26% in free cash flow margins. And I do believe eventually we will get back to this 30% mark, but this is where we are right now. And let me show you why PayPal is so attractive. Now, before we do that, if we go to the forecast here, we can see the average price target for PayPal is $92 over the next 12 months. That would represent 32% upside from where we are right now. And the market is factoring in about 6% annual revenue growth over the next 3 years, with slight acceleration in revenue and about 8 to 12% in earnings growth for this name. So that leaves us in a situation where if we plug in 6% revenue growth over the next 3 years and then decelerate 4, and then we actually see margins expand from 19 to 23%. Do take into consideration free cash flow margins in the last quarter were 26%. So I think this is a very reasonable target in my opinion. If we do that, so we'll have $41 billion in revenue and a 23% free cash flow margin. You're looking at free cash flow of $9.5 billion in 2029. Multiply by a 12 times EV to free cash flow multiple, subtract the debt, add the cash, and then divide by shares outstanding. I'm assuming shares outstanding going to decrease by 3% every single year over the next 5 years to get 800 million shares outstanding. That puts PayPal's price of $140 in 2029. It currently trades at $70. That would represent a 15% compounded annual growth rate. And again, conservative estimates. The management team are actually aiming for 10% earnings growth by 2027. And if those estimates materialize, the stock is dramatically undervalued. Furthermore, we could see margins go to 26%. And on my absolute bull case scenario, there is a situation where PayPal compounds at 22% over the next 5 years per year. However, a lot of that move will be loaded in the back end of 2027, 28, and 2029. So this is a stock where you're going to see excess returns if management can hit their long run targets that they want to achieve as per their investment day. But that is all from me today, guys. Thank you for watching this video. If you like this video, please go ahead, subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.